Right now, gold is sitting at a level most analysts didn't expect to see again this quickly, and over the next few days, two forces that rarely collide at the same time are about to test it at once. One is coming out of Washington. The other is coming out of the Middle East. If you're holding gold or thinking about it, what happens in this narrow window could shape the next several months of price action more than anything that's happened in the past few weeks. Here's where things actually stand, because the headlines you've probably seen only tell half the story. Gold touched roughly $4,150 an ounce this week, its highest level in about 2 weeks, climbing more than 1.5% in a single session. That move wasn't random. Investors were reacting to two things at once: rising tension in the Middle East and growing anticipation of next week's Federal Reserve meeting. The financial press tends to cover those as separate stories. For gold, they're tangled together, and understanding why matters for what comes next. Here's the part most casual coverage skips over. Gold is still down almost 30% from its all-time intraday high, set back in late January, just above $5,500 an ounce. That's a real pullback for an asset that, a year ago, was in the middle of one of the strongest 12-month runs in its modern history, up more than 90% at one point. So the question worth asking isn't why gold went up this week. It's why gold fell so far from its peak in the first place, and whether anything has actually changed enough to reverse that, or whether this is just a bounce inside a longer correction. To answer that, you have to look at what pushed gold to $5,500 in January, because none of that has disappeared. It's just gone quiet for a while. Central banks around the world have been buying gold at a pace that's extraordinary by historical standards. World Gold Council data shows central bank gold holdings pushed past 5,000 tons for the first time on record last year, and 2025 alone produced more than 50 new all-time highs in the price. Central bankers don't accumulate at that scale because they're chasing a trend. They do it because major economies are working to cut their dependence on any single reserve currency, move away from sovereign debt that carries political risk, and hold something that sits outside anyone else's financial system. That's not a short-term trade. It's a repositioning that's been building for years, and the institutions driving it haven't shown any real sign of slowing down. At the same time, government debt levels across major economies keep climbing, and the cost of servicing that debt has become a bigger part of the conversation among policymakers. When a government's borrowing costs rise faster than its revenue, investors look for alternatives that don't depend on any single treasury's promise. Gold has historically been the answer, not because it yields anything, but because it doesn't need anyone else's balance sheet behind it. So if all of that is still intact, why did gold fall almost 30% from its January peak? That's the other half of the story: interest rates and what the market currently thinks the Fed is going to do next. Elevated inflation readings earlier this year pushed traders to start pricing in a real chance the Fed's next move is a hike rather than a cut. That's a big shift from where sentiment sat at the start of the year, when cuts were the base case. Higher rates make gold more expensive to hold since gold pays no interest, no dividend, no coupon of any kind. When Treasury yields climb, the cost of parking money in gold instead of something that pays you goes up, and that's been a major reason gold hasn't been able to hold its early year highs. There's a detail most gold coverage glosses over entirely, though, and it matters more than people give it credit for. The Fed's own policymakers don't agree on what happens next. At the central bank's most recent projections release, of the 18 participants who submitted forecasts, 9 projected at least one more hike before year-end, 8 projected no change, and 1 projected a cut. That's about as divided as a major policy committee gets. The Fed's current chair didn't even submit a projection, which most market watchers read as a deliberate signal that leadership itself isn't ready to commit to a path. When the people setting policy can't agree among themselves, that uncertainty gets passed straight into every rate-sensitive asset, and gold is about as rate-sensitive as it gets, which is part of why the next several days matter more than usual. CME Group's FedWatch data currently puts the odds of a hike at next week's meeting around 1 in 5, but the odds of at least one hike by September climbed to somewhere near 60%. Read that carefully. The market isn't betting on a hike landing next week specifically. It's betting the Fed keeps the door open, using its language to prepare investors for tighter policy sometime soon. Whether that language comes out hawkish, dovish, or deliberately noncommittal is going to move gold more than almost any single data point released this month. That's why gold holders are about to move through a stretch where several pieces of information land in quick succession, each one capable of shifting sentiment before the main event even arrives. In the days immediately ahead, weekly jobless claims are due, followed shortly after by new residential sales figures. Housing and employment numbers don't look like gold catalysts on the surface, but they feed straight into how confident the market feels about the Fed's next move. A stronger jobs picture reinforces the hawkish case, which pressures gold lower in the short run. A weaker one does the opposite, handing the doves inside the Fed more ammunition and giving gold room to climb. These are the kinds of releases algorithmic desks parse in seconds, moving gold $30 or $40 before most retail investors have even seen the headline. Then there's the geopolitical situation, which remains genuinely unresolved. Tensions between the United States and Iran have kept escalating, with reports of ongoing strikes and retaliation over the preceding days. Officials have said publicly that the U.S. remains open to diplomacy, while making clear that continued disruption of shipping through the Strait of Hormuz won't be tolerated. That corridor matters enormously to global energy markets, since a large share of the world's oil shipments pass through it. Any serious disruption there pushes energy prices up, and higher energy prices feed directly into inflation data, which feeds directly into what the Fed does with rates. It's a chain, and gold sits at the end of it, absorbing the uncertainty from every link along the way. Put those pieces next to each other and you get a Fed meeting on the calendar for next Wednesday, a conflict that could cool off or escalate within days, and a run of economic releases landing in between that shape expectations before policymakers even open their mouths. Any one of those alone would be worth watching. Having all three stacked into the same narrow window is what makes this stretch different from an ordinary trading week. So what could actually happen from here? Worth walking through honestly, because nobody can tell you gold is guaranteed to do anything, and any script that claims otherwise isn't being straight with you. In the bullish case, the Fed signals continued caution instead of committing to a hike. Tensions in the Middle East escalate rather than cool, and incoming data comes in soft enough to keep rate cut hopes alive later in the year. Under that mix, gold's underlying demand, the central bank buying, the reserve diversification, the general discomfort with holding purely paper-based assets would likely reassert itself, and you could see gold push back toward its January highs and potentially test new record territory. Some of the largest banks in the world are leaning this direction already. JP Morgan has floated a target of roughly $6,300 an ounce by year, and other large firms have put out numbers in the $6,000 range too. Worth being blunt about what these are: forecasts built on assumptions about central bank behavior and geopolitical developments that haven't happened yet, not guarantees. Treat them as one input, not something to plan around. In the bearish case, the Fed comes out of next week's meeting genuinely hawkish, maybe even opens the door to a hike sooner than markets currently expect. Tensions in the Middle East start easing, and the data keeps showing a resilient labor market and sticky inflation. In that world, real yields climb, the cost of holding gold goes up, and the metal could face further pressure, potentially testing levels well below where it sits today. That's not a fringe outcome. Given how split the Fed's own committee is right now, it's very much on the table. The honest answer, the one nobody trying to sell you certainty will give you, is that both outcomes remain genuinely plausible, and whichever combination of headlines lands over the next few days will probably tip the balance for the following several weeks of trading. There's also a longer story sitting underneath all this day-to-day movement, and it's worth pulling apart from the short-term noise. Gold's job in a portfolio has always been less about generating returns like a stock and more about acting as insurance against the kind of stress that shows up when confidence in the broader financial system weakens. Looking back from 1971 to now, stocks have generally outperformed gold on average annual return. But that's not really the comparison that matters if you're holding gold for protection. What matters is what happens during the specific stretches when confidence in currencies, sovereign debt, or the financial system comes under real pressure. That's when gold has historically earned its keep, not by beating every asset class every year, but by holding value or gaining it exactly when other assets are struggling. View this week's developments through that lens, and they look a little different. The Fed's internal disagreement is a signal that even the people closest to the data aren't confident about the path ahead. Escalating conflict in a region that supplies a large share of the world's energy runs straight into inflation expectations. And a market already pricing in a wide range of outcomes for the coming months can swing hard in either direction the moment new information shows up. If you already hold physical gold or gold-backed positions, this is a moment to pay attention rather than panic. Sharp short-term swings in either direction are normal for this asset during periods of real uncertainty. The structural case, driven by central bank accumulation and reserve diversification, hasn't gone anywhere. What's playing out right now is a shorter-term tug-of-war between that demand and the near-term pressure coming from Fed expectations. Figuring out which force is winning at any given moment means watching the data as it lands, not reacting to a single day's headline. If you're thinking about a first position, this window carries real risk simply because of how much event risk is packed into it. Prices could move meaningfully either direction within days, based on information that hasn't been released yet. That's not an argument against the asset. Gold has proven its relevance across multiple economic cycles, but it is a reason to think carefully about position size, time horizon, and how much short-term volatility you can actually sit through. Nobody, including any analyst quoted in the financial press this week, can tell you with certainty which way the next 72 hours breaks. What can be said with confidence is this: a divided Fed heading into a high-stakes meeting, an unresolved conflict tied directly to global energy markets, and a wave of economic data landing just before policymakers speak is exactly the kind of setup that's historically produced outsized moves in gold in both directions. Whether this stretch becomes the moment gold resumes its push toward new records, or the moment it slides further into its current correction, probably comes down to details still unfolding as you're watching this. Worth watching closely rather than assuming you already know how it plays out. Markets have a habit of humbling anyone too confident in either direction, and gold has a long history of proving both the bulls and the bears wrong before eventually settling into whatever trend the fundamentals actually support. So here's where that leaves things. Don't let one headline, one line from the Fed, or one geopolitical development decide how you feel about your position. Look at the whole picture. Central banks are still buying at historic levels. Government debt dynamics haven't reversed, but near-term rate expectations and geopolitical developments can absolutely create real volatility along the way. Both things are true at once, and the investors who navigate this kind of stretch well are usually the ones who hold that distinction in mind instead of chasing whatever moved yesterday. If this helped you make sense of what's actually happening underneath the surface, take a second to like the video. It genuinely helps this channel reach more people trying to think clearly about markets instead of just reacting to headlines. Share it with whoever's been asking you what's going on with gold lately. Drop a comment with which scenario you think plays out, the breakout or the deeper pullback. I read through these and they shape what gets covered next. And if you want to stay ahead of how this develops over the coming days, subscribe and turn on notifications because this is moving fast and the next update could come sooner than you expect. Thanks for watching. See you in the next one.